Hey guys, and welcome to today's video. So in today's video, we're going to be discussing a step-by-step guide to market turning points and institutional swing points. So without further ado, let's get right into it. So when we talk about institutional swing points, it's very, very important that we start from a very basic level and understand what actually moves the market. So if you're new to the ICT concept, this may be new to you, but if you're not new to the ICT concept, it is probably something you should already know by now. So what actually moves the market is none other than the IPTA, which is the interbank price delivery algorithm. So this is what actually moves the market, not buying or selling pressure, but actually IPTA, interbank price delivery algorithm. Now, moving on, the next question is going to be how does the market actually move? And when we actually ask this question, we're simply implying, in other words, how does the algorithm actually delivers price? Now, to answer that, it's very, very simple. The algorithm actually deliver price from an area of buy side liquidity to an area of sell side liquidity or vice versa, or from an area of inefficiency or imbalance to an area of liquidity, or this can also happen vice versa. So with that out of the way, we've already established a foundation that's going to help us understand institutional swing points. Now moving forward, what are these areas of inefficiencies or liquidity, if any of you may ask? They are simply institutional reference points, also known as PDRAs, and they are none other than the popular thing we know, which are order blocks, fair value gap, liquidity pools, and etc., the breaker block mitigation, and so on and so forth. So let's move forward. Institutional swing point. So when we talk about institutional swing point, we're simply implying the turning points in the market or market turning point. We want to understand these turning points in the market or the market turning points and how it actually happens. That's what we're trying to imply. That's what we're trying to understand. And it's very, very important that you understand that prices moves in swings and ranges. And courtesy, that was actually created by me. So that quote was actually created by me, and it's actually true, obviously, because based here on this particular chart, this is a line chart right here. You can see from this low to this particular high is actually a range in the marketplace. You understand? From this low to this particular, sorry, from this high rather to this particular low, it's another range. From this low to this particular high, it's another range. From this high to another low is another range, and what created all these ranges are none other than swings, which are swing low, swing low, swing low, or swing high, swing high, swing high, which in market structure terms we're going to call higher highs and higher lows. I don't really get what I'm trying to say, but they're actually swings. You understand? So what actually forms the market and the rhythm to which price actually moves is in swings and ranges. Good. So you can also see it clearly depicted with this particular line chart right here. So moving on, when we talk about institutional swing points, it's very, very important that you understand this basic idea because this is going to build your understanding of institutional swing points. So when we talk about institutional swing point, we're simply referring to what you can see right here on the screen. Now, this is going to be very, very paramount for a bearish perspective. So we're talking about institutional swing point. In other words, we're talking about swings created by institutional players in the market. Or simply saying, going to look at, okay, this is how they actually plan out their orders. This is actually how they play out these particular orders that we're looking out for. And this can happen across all time frame. You may be looking at it on this particular time frame at a very major key institutional level. And you may say we are not seeing this, but the truth is that either you go on a lower time frame or a higher time frame, you're going to definitely see this particular pattern or concept or idea in that particular area or zone. So this is going to be very paramount for you to be able to understand it. And what are these things? This is none other than the liquidity run on this particular level and a fall, also known as a market structure shift right here, creating this particular low here as a breaker block. And this other one is going to be a failure swing right here, price failing to take out this particular high right here. And here is going to also serve as a mitigation block. You get what I'm trying to say? So this is going to be for the bearish perspective, and for the bullish perspective, we're going to have what we call the W pattern right here. You understand? So price is going to create something that looks like a W right here. Price running this particular low and advancing higher after tanking into a very serious institutional level right here. So price is going to come back to revisit this area and keep pushing back higher. Same can also be said for this area. Price drop down right here at a very key institutional level, failing to take out this particular low and tanking at an institutional level within this particular price range right here. You understand? And from then on, price pushed higher. So price is going to come back to visit this particular high later on. So moving forward in price, let's see some examples. So let's say we have this particular piece of price action as we get into C price, and um, from an imaginative perspective, let's look at this particular swing low. Sorry, let's look at this particular blue line right here as a very key institutional level in price, which it actually is. You know what I'm trying to say? But based on the presentation, we won't have the luxury of going back in time to see that actually. So let's say we're watching price and price does this right here. So you can see the way price dropped into this particular key institutional level. This is actually a liquidity pool on the 4 hours. You understand? This is a liquidity pool on the 4 hours. So you can see the way price dropped into this particular area and you can see the way it reacted immediately. But long before price reacted immediately, you can see price tried to drop aggressively first to this particular area but failed to do so. But on the second pull, it actually did that. So this gave us the W pattern right here, which is not a failure swing but a liquidity run and creating a breaker just running all the way to the buy side right here. Good. Now, it is very important that we mark out this particular high and this particular low in price because these are going to be key significant area in price because these are going to start building our institutional swing point level. How do we get now? Because now these swing point levels are going to act as support and resistance zone going forward in price. Good. So as we begin to pray price, we can see the way price rallied aggressively, creating this particular institutional level right here. And you can see the way price came back into that particular zone. You can see the way price dropped into the zone, did not go below this particular line, which is this low of this breaker block and the high of this particular breaker block that was formed at this institutional swing point here. You understand? You can see the way price did all its old shenanigans within that zone. I can see the way it expanded higher right there. So this to tell you how significant this particular area is right here. Some of you may say, it's default. You are getting what I'm trying to say. You should just stop here and go up. That could be the case most of the times, but majority of the time, you don't want to see price exceed. You want to watch how price react within this high and within this low of this particular swing point zone. You know what I'm saying? And that's going to help you frame your idea, and that's also going to come as a matter of you blending time and price together to be able to arrive at this particular kind of scenario. But without further ado, let's go forward as a result of this particular swing point um, level. So moving forward right here in time, we can see that coming into the London session, because this is actually the London session, you can see the way price retraces back into that zone, tanking at that area, price tank on the area again, and one more time breaking through, but just running this equal lows created just before the London session, and you can see the way price expanded all the way to the buy side. But what was creating the support and resistance level? None other than this particular swing point area right here, this particular swing point zone. So you can see the way the swing point zone is acting as a support and a resistance zone in the marketplace. Good. So now moving forward, we can see that price eventually came down all the way again into this particular institutional swing point level. And we know that obviously price is not just coming for just the institutional swing point. There are other areas of liquidity that price coming for, which is this low and this other swing low right here. You understand? So these are areas, but I want you to watch how price did not go beyond this particular zone right here. That's beyond this high and this particular low right here. You can see the way price just reacted in between it and expanded aggressively all the way to the buy side. That will tell you the importance of this particular institutional swing point, how it helps us frame support and resistance idea. So moving forward in price, let's look at this for a bullish perspective. Sorry, for a bearish perspective. We just saw how that's played out for a bullish perspective. So let's look at how it can play out for a bearish perspective. So using the same price action. So let's say we're viewing price right here. We can see a series of high price around that particular series of high and drop down aggressively. Good. So what are we going to be paying attention to? We want to see the reaction in price. So our eyes can go to this low and to this particular high right here, and we can be watching out for those areas in price. But we're watching price. Let's say we're watching price and price does this. Good. That now gives us a signal because we can see the way price ran aggressively to that particular high that took out this high series of highs and dropped down aggressively on that candle. So that now sends our focus on this to this high and to this particular low. That's going to act as our institutional swing point zones, which is going to help us define support and resistance level later on going forward in price action. So let's mark those areas out. So we can mark out to those areas right there, and we can see the way price traded aggressively away from that A level. Good. So we marked out those particular area right there. So let's say we are watching price and price does this. Wow, a lot of us will be like, wow, we've missed it. This doesn't work. Good. You can say that. But one thing I want you to understand is that you have a support and resistance level doesn't mean price is always going to trade to that level all the time. Good. So, but I want you to notice that based on ICT concepts, and which I also teach on this channel, that price actually traded into this particular fair value gap right here. And you can see the way price traded down aggressively. So, without further ado, let's keep watching price and see how it plays out. Boom. You can see how price returned back to that particular area right there because this is a very key zone. So as price was trying to buy back right here, it's met its resistance. It's met its dead end. It could no longer push higher. Good. Now, our eyes could go literally and say, okay, we just had a liquidity run. Yes, no doubt. You understand? We just had a liquidity run. And that's the way I was going to trade this too. You understand? Because I love trading from areas of liquidity. Good. But the point is, I want you to see if it was just the liquidity area that price was coming for, price would have just wicked above it and not stress about touching this zone. But you can see the way price stretched aggressively to the peak of that particular low right there. You understand? And you can see the moment it touched that line exactly, it dropped down aggressively. That's not random. You understand? That's neither magic. It's the algorithm. That's the way the algorithm has been programmed to operate. So these are things that you must understand and look out for in price when trading the ICT and the smart money concepts. When you see things like this, it gives you confidence in engaging price. And to show that that particular area was very significant, if you play out price going forward, we can see that we've already exhausted everything right there. So price didn't really have any need to come into that zone and repelling. But you can see why even price broke through it. You can see the reaction and the effort right here that price had to take before pushing aggressively. And even if you pay attention now, based on swing points, you can see we have this particular swing high right here. And the moment price broke above this high, breaking into this particular area right here, you can see the way this candle came down and retest on this particular high. Why? Because this particular high is actually an institutional swing point. This high to this particular low, because this low took out this low and took out this low right here. You understand? So this low to that high, this high to this low. So this particular high to this low is very, very significant in price. How do we get it now? So if price was going to come down, you're going to see a reaction around that level also. And you can go to your chart and check it. The price action I'm actually using for this example is the 1st of December, the 30th of November to the 1st of December 2023. So you can go and check how price was coming down and how it reacted from this high to this particular low. I know I said from this high to this particular low earlier, but that was just a mistake. I meant from this particular high to this particular low. So go and see how price reacts from this particular high to this particular low right here. And you're going to see the reaction of price. And then we get it now. So these things are very, very key and sensitive areas to help you frame support and resistance, not touching retail minded things, but actually using the institutional perspective on price to better frame a good risk to reward and better also know what direction you should be pushing for. And then we get what I'm talking about. And just to add some sugar and icing to this whole presentation, you can see the way price pushed aggressively on this candle, and you can see the moment before this particular candle closed, you can see if this particular candle did not break like aggressively above this particular high right here, you can see the way this particular candle stopped on the peep on this particular line. You just watch how this particular candle closed exactly on this particular line. And what's this particular line? It is this particular high over here. If it was random, if it was buying pressure or selling pressure, price would have just went and go aggressively above the high. But because of this is an algorithm controlling price, it had to respect that area before coming down and pushing price higher. How do we get it now? So these things are right there in the chart, and you can use this to better improve your trading. So I hope you found value in today's video. If you do, hit the like button, hit the subscribe button, and see you in more videos.